Welcome to our Rural Research Symposium. Welcome again. And welcome to our panel discussion today on housing market dynamics, and the rural economy. This session is being recorded and will be available after the event. I'm Larice Brown, Senior Economist and Director of Quantitative Analytics for Freddie Mac in our Single Family Division. And I'm joined today by Robert Dietz. He's the SVP and Chief Economist at the National Association of Home Builders. Lynn Kiefer, Deputy Chief Economist at Freddie Mac. And Trevon Logan, Professor of Economics and an Associate Dean at The Ohio State University. Their bios are available for you to view on our Single Family Freddie Mac website. Today, we will be dissecting past and recent trends that have significant impact on rural economic growth. We'll start our discussion with Rob Dietz. Rob has over 15 years of experience with the National Association of Home Builders. He provides a focused lens on building trends and implications for housing supply. Rob, could you share some of the recent home building and supply trends you're observing? We would be particularly interested in any differences starting in the second quarter of this year that might be related to the COVID-19 pandemic.
Yes, thank you, Larice, and thank you to Freddie Mac for inviting me to participate today. The second quarter was really dramatic for housing demand and for housing supply. I think if we look back to March and April, we were expecting pretty large declines for housing market activity, and in particular home building in 2020. Instead, what we saw was a really staggering amount of growth in the demand, particularly for sale single-family housing, and not just a rebound, but an actual accumulation of growth in the home building industry. So in my presentation, I'm going to walk you through some of the dynamics that are affecting housing supply. I think the one common factor, whether it's new construction or the resale market, is that the industry right now really lacks inventory. And so I'm going to address the factors that are holding back the amount of housing supply in the industry. So let's start off first with what was the state of home production going into this downturn. And it was really different than, say, the state of the industry as we entered into the Great Recession. An interesting way of doing this from an apples to apples perspective is to look at the amount of single family homes that were built per year, per million population in the United States by decade. And that's what you've got in front of you on this slide. What you can see is in the 1980s, 1990s, and the early 2000s, the United States was building about 41,000 single family homes per year per million population. And then over the last decade, which we in the home building industry call the long recovery, it was kind of an incomplete recovery, that pace of construction fell by half. Now, some of that was due to lower population growth rates, lower immigration, but a lot of it had to do with these certain supply side headwinds that have limited housing production. And we can see that very clearly on this next slide, where if you look at, for example, the blue line, which is single family housing starts over the last decade, the levels were at historic lows, and they never really recovered to the level of production that we need to be at. We estimate that based on demographics, second home demand, the need to replace older housing and aging housing stock is a key challenge in rural housing markets. We probably need to be building about 1.1 to 1.2 million single-family homes a year. And in recent years, we've only been building about 800,000 or so. Now, for the year, as I said before, due to lower interest rates and a changing geography of housing demand that I'm going to walk you through on some maps, 2020 is actually going to be an up year for home building activity. In fact, we believe that single-family housing starts will likely end the year 6% higher, and new single-family home sales could end the year 15 to 20% higher. And the driving factor behind that is those low interest rates, the demographics, including millennials. The leading edge of the millennials is now turning age 40. And, as they move into their upper 30s, the demand for single family housing continues to grow and grow and grow. So again, if you look at that blue line, you can see that it's really kind of been below levels that we saw, say, in most of the 1990s, the early 2000s. And the question is why? And what we've said over the last few years in terms of looking at the level of home building production is one of the limiting factors for housing supply. And we've called these the 5Ls. We started with 3Ls, and as we added different challenges to the industry and analyzed them, that amount grew. And they are labor, building materials, most importantly, lumber, lending to builders. Typically in housing markets, we talk about lending to home buyers, but this is lending to land developers and builders. And that's particularly a challenge in rural housing markets and small towns because it's smaller builders that get their financing from a bank. That's key in terms of getting financing. Access to land and lots, that's been a challenge in a lot of markets. The land development pipeline's a lot tighter than it used to be. And laws and regulatory burdens. In fact, we estimate that about a quarter of a typical newly built single-family home's purchase price is due to various kinds of regulatory burdens, with 2/3 of those connected to the land development process. Now, that's an area where rural housing markets actually have a competitive advantage, because in our research, we do find that those regulatory burdens are higher in urban areas, in central cities. And in fact, for a typical apartment building, those regulatory burdens represent about 1/3 of the development costs. So rural housing markets tend to have that kind of lower levels of red tape and regulatory burdens. Labor, though, that's a key issue. We've had a skilled labor shortage in the construction industry, and it's particularly acute in markets that have lower density, lower population levels. That's because we have an aging workforce, and frankly, the industry is not doing a great job recruiting young people into the construction industry. So I do believe that is a key challenge for rural housing markets. And I mentioned lumber. This is really the near-term concern in terms of being able to add housing supply and build homes. Over 2020, starting with the spring when it became clear the housing demand was really taking off, and it wasn't just new construction, by the way, remodeling has been really strong as people have a renewed focus on home, trying to use their homes for more purposes. Lumber prices really began to skyrocket. In fact, in early September, they reached to about 170% increase from mid-April. Now, the good news is, and this data continues to move quickly, we've actually outpaced my slide here, but current lumber pricing as of mid-October has fallen to about $700 per thousand board feet. So it looks like it's peaked. We haven't seen a lot of increase in production. That ultimately is what we need. And futures markets are indicating that we should see lumber prices fall to about $500 per thousand board feet by the end of the year. That would be good news for home buyers and renters and remodelers and the like. But ultimately, we need to increase domestic lumber supply or reduce some of these tariffs that we've imposed on Canadian lumber over the last few years. We have a 20% effective tariff rate on Canadian lumber, which represents about 1/3 of our lumber supply. So we definitely hear from builders that the access to materials, and it's not just lumber, it's appliances and other kinds of materials that go into building a home, literally the nuts and bolts that go into building a home, are in short supply. So the other factor, and this is something I've mentioned already, is that there's a geographic shift in housing demand that's taking place. Now, I'll say that for the last few months, this has been an active source of debate in the media among various housing analysts. Some went as far as saying it was a marketing myth that didn't exist. I strongly disagree. I am in the camp that basically says that we've seen a very important shift in housing demand moving to the lower density markets. And the reason why is because of housing affordability headwinds, cost concerns, and the technology of working from home and allowing people to commute longer. And it's not just, someone who used to work in New York City and now lives in, a beach community in North Carolina. That's pretty rare. But the idea that people now have the ability maybe not to go into the office 5 days a week, they'll only go 2 days or 3 days or 1 day a week, which means their commute in terms of an acceptable time of commute grows. And so their ability to decentralize increases. So I'm going to give you the data for the second quarter. As Larice said, we're evaluating the second quarter in terms of trying to judge some of these impacts. In terms of building data, so what you see on this map in front of you, the blue counties are the core counties of the United States, of large metros, areas with more than 1 million population. They represent 18% of single-family home building. And in the second quarter, compared to the second quarter of 2019, they were down 17%. Now, these are the highest density areas, and this is the worst performing building region as an economic geography that we track. Now, if we take a step out to a lower density area, the suburbs of those large metros, this is 25% of single family building, and now down only 9%. So still down, but a better performance than what we see in the core counties. Now we take a further step out. These areas in light blue represent the exurbs of the United States. They're the outer suburbs of those large metros. They represent about 9% of single family construction. You can see a little bit better performance than even the suburbs. Still down about 9%, but better than the core counties and the suburbs. Now, if we take another step out, we're now looking at core counties of small metros, metropolitan areas that have less than 1 million population. This is the largest building region that we track. It's almost 30% of single family starts. You can see a lower density market, still better performance, now down less than 6% year over year in that second quarter. And now we get into some of the more rural areas. These are counties that feature a small town, but a lot of rural territory, 6% of home construction, and down only negative 3% year over year. So again, lower density market, better performance. And now we get into outright rural areas, 4% of single family construction and down negative 2.7%. So again, as we move to these lower density markets, we get relatively better performance. And now finally, we get to an area that's not in rural markets, but these are the outer suburbs of small metros, 9% of single family construction, and they actually post an outright gain, up almost 3%. So I think when we look at the construction data in single family construction, we clearly see lower density markets, better performance, and I think that's a positive growth trend for rural areas. And oh, by the way, it's not just single family construction. We see it in multifamily construction as well. On this map, you've got rural areas, small towns, small metros, only 30% of apartment construction in these markets, but these areas were growing faster than the other 70% of apartment construction. So when we look at it, obviously in the home building industry, we have opportunities and challenges. The opportunities are we have a housing deficit, we have good demographics. The changing geography of housing demand is benefiting low density markets, including small metro suburbs, including rural areas. We do have an aging housing stock, so there's a remodeling need, particularly in rural areas, to improve the efficiency, energy efficiency, to improve that existing housing stock. But there's an advantage for rural markets in terms of lower regulatory burdens. But the challenges are clear. Rural markets, small towns feature small, privately owned home building companies. They need access to financing. The skilled labor shortage continues. And we really need to shore up the supply chain because that is a near-term challenge in being able to increase housing supply and improve the existing housing stock. And with that, I'll turn it back over to Larice. And again, I was happy to join you today.
Thank you, Rob. Thank you for sharing those 5 L's and some bright light into what might be going on in the rural areas. I was wondering, to what extent was the trend in the low-rise garden-style apartments picking up prior to Q2 versus after? Did you see that? And do you have a sense as to whether these new homes are near employment or transportation or near highways, suggesting automobile commuting, or neither?
I think that's an important point. It's easy to say, when it comes to an urban exodus, there's no exodus. There's a shift in demand. And so one of the things that we definitely saw was there were existing trends to moving to a decentralization of apartment construction, single family construction. And after the virus, and this has become a cliche at this point, but we accelerated a lot of existing change into a short period of time. So those existing trends of decentralization because of housing affordability headwinds were already there in rental markets, in for sale markets. And what the work at home trend, the technology trend, maybe a desire to get out of some of these higher density markets has simply accelerated that. Now, that does mean that some of that new construction is away from transportation. So, if we're looking at an infrastructure bill in 2021 as a bipartisan piece of legislation, we need to make sure it includes infrastructure in some of those lower density ex-urban markets and rural markets.
Thank you, Rob. I appreciate that information. We're going to turn over to Trevon Logan, our professor from Ohio State University. Trevon, we appreciate that you bring in the economic history to provide perspective for the demographic trends we see today, including issues such as racial and wealth disparities. Could you share some of your insights into racial wealth disparities in rural areas and how they might be impacted by the current pandemic?
Thank you, Dr. Brown, and I really appreciate the opportunity to come and speak to all of you today about this. So I think one of the main points in looking at these trends for a long period of time and thinking about them for several decades is we know that there is a disparity between economic development in rural areas and urban areas. And we also know that there are racial disparities in economic health of African American families, say, versus white families. What we typically don't talk about is the degree to which they're intertwined, so that we cannot talk about regional disparities, say urban and rural disparities, without talking about the racial dimension. And one feature of the racial disparities that we see in economic outcomes is due to rural and urban disparities as well. But let's start with the coronavirus itself, because it is something that is exacerbating racial health inequality. We know that African Americans, Hispanics, and Native Americans have substantially higher case rates, much higher rates of hospitalization, and in particular, for the case of African Americans, much higher death rates from the coronavirus pandemic. This is coming from the CDC's information before the latest uptick in the coronavirus, which is really having a disproportionate effect, not only racially, but also spatially. So if we look at what the pandemic looks like today in these areas, you'll see these hot zones in the coronavirus. This is through the beginning of September, and this has continued and in fact accelerated in these areas. You'll notice that the pandemic now is concentrating itself in the plains, say North and South Dakota, in rural Missouri and rural Illinois, and in Mississippi, in Alabama, and in Tennessee. These are predominantly rural areas that are now bearing the brunt of the pandemic. And it's running out of control in these rural areas. It's important to understand that there's racial distinctions in these areas as well. So not in the Dakotas and not in rural Missouri are these places disproportionately African American, but in this southern Black Belt, this area, which we would call the African American rural South, is an area where the pandemic is having a particularly negative effect for African Americans. They comprise the majority of cases in these areas. So when we're talking about the racial disparities in coronavirus, we have to then account for these regional disparities in the fact that this is now becoming a rural pandemic. And in places that are Black and rural, we see the coronavirus having a particularly negative impact. It is not only racially disproportionate, it is highly so. So today, 1 in 1,000 Black Americans has died of COVID-19. And the coronavirus for this year already is the third leading cause of death for African Americans. And this is a disease that had not killed anyone in the United States until February of 2020. So something new has come along and had a disastrous effect on African American health. And it is related to infrastructure and health capacity, particularly in rural communities, but also in urban communities. And so what does that mean for the economy in these places? So if we're looking at unemployment rates by race, we have systemic higher unemployment for African Americans that continues even as the job market has improved with the ending of the shutdowns in the pandemic, as we've gone through, these are the most recent unemployment numbers. We still see African Americans with unemployment rates above 10%. But what does this look like in rural areas? So we see that if we're going through and looking historically, rural areas had structurally higher unemployment than urban areas. And at the peak of the unemployment spike, actually rural areas were doing better than urban areas, even though they had this structurally higher level of unemployment. And that trend between rural and urban communities continues. So the employment market is actually a bit stronger now in rural communities than in urban communities. But layering upon that, the racial disparities tells us something very interesting. So the unemployment rate for African Americans is higher than it is for any other racial or ethnic group in the United States today. It is above 10%. And in fact, the racial disproportions don't really satisfy what we consider to be our conjectures economically about who would be more likely to be unemployed. So whites with limited education are actually doing much better than the average African American in the labor force. So there are still these racial disparities that we have to think about. And it's important when I'm just talking about the coronavirus to stress that these distinctions between racial inequality and rural-urban inequality are long-run trends. They're not something that come about from just a simple application of, say, today's events or our immediate responses to the most immediate economic outcomes. They actually reflect long-run policy. For example, if we're looking at racial income inequality, it has remained the same over the entire post-civil rights period. There's been no change in the mean or median racial gap in wages that we see for African Americans versus whites. So despite a lot of discussion about progress that has been made on racial equality issues, economically, we are not seeing anything budge in that area. When we turn this over to things like housing or housing wealth, we then would expect a lot of things to be actually quite stagnant in those regards. If we're looking at racial wealth inequality, it has actually gotten a bit worse. There was a significant decline in white wealth in the most recent housing crisis because, of course, the majority of wealth for the average household is held in the form of home ownership and home equity. That did take a significant hit in the last recession, but the racial gap between blacks and whites has actually gotten a little bit worse, primarily because the little bit of wealth that African Americans had accumulated by the time of the last recession has essentially gone away entirely. So it's incredibly important to understand what is going on with that. If we're looking at these features of wealth inequality, they once again defy simple economic explanations. In the United States today, a white person who does not have a high school diploma, on average, has more wealth than a black person who has a college degree. So it is not a simple solution to think about investment in education or other sorts of things in solving this racial wealth inequality. And what we know about American history and economic history is that wealth begets wealth. So those who lack wealth typically lack the resources to accumulate subsequent wealth, and of course are unable to pass it on to their children. And that has particularly negative effects for something like the housing market. And when we turn to these communities and these rural communities, I want to highlight the disparities that exist in the business climate in rural communities. If you're looking at this diagram, what you'll notice is that in the African American South, that area that I was highlighting earlier, that had this majority of these Black coronavirus cases, is an area that has been decimated in terms of its business climate, in terms of new business starts. So there are rural areas that have grown and accelerated in their growth, but the area that is doing the worst in terms of its basic business start development is actually these places in the rural African American South. If we go again and look at the proportion of people who have economic distress by zip code, so the areas where we have high levels of inequality, high levels of unemployment, low levels of income, and low levels of wealth. These areas as well are concentrated in this African American South when you're looking at these rates of economic distress. And what does this mean when we're thinking about markets in a very different way is mobility. So if we're looking at mobility, this is intergenerational transmission. And we're looking at the likelihood that a parent who is in, say, the 25th percentile of the income distribution has a child moving up to the top quintile of the distribution. The lighter areas on this map detail places of low mobility. And what you will see is that the places of particularly low mobility are once again in this rural part of the African American South. If we compare the areas overall in the South, in these southern rural communities, places that are in the African American South are basically at half of the mobility of these rural communities overall. And that tells us that these are places that have lack of access to capital, low rates of social mobility, and we would expect there to be particular problems in terms of accessing home ownership in these areas, given their business climate and given the structural inequality that exists there. Most important, this finding about intergenerational mobility today is a long run trend overall. If we're looking at this pace of racial inequality in intergenerational mobility, this is not something that begins with the 21st century, but in fact is something that has roots throughout the 20th century. So when we're thinking about policy, particularly policies in rural communities, we have to think about how racial inequality has impacted these policies in rural areas. And once again, how rural areas and interactions in rural areas are predicated on some of these racial inequalities. And with that, I'll go back to Larice and look forward to her questions.
Thank you, Professor Logan, as always, providing wonderful insights into how that historical perspective plays out today, even as we deal with the current pandemic. You pointed out some specific geographies as having a large portion of rural and African American communities, such as the rural South. And I believe you've done some research into some of the historical factors that have led to significant losses in wealth for these communities. Can you share a highlight or a quick story from that research with our audience today?
Yes, I appreciate you asking a historian to tell you a quick story. So I will try to be as concise as possible. There's one race riot from a rural community that people don't talk about very much, and it's Elaine, Arkansas, in 1919. It is about 75 African Americans who were landowners, and the race riot there started when they did not want to sell their cotton to the local cotton gin, who was paying below market prices for cotton. There were about 200 people killed in this race riot in a very small town in Arkansas. But if we look at the land that was confiscated and just the equipment that was confiscated in 1919, it works out to being about $500,000 per family here. Overall, the wealth lost, the expropriation of wealth, was about $10 million in this rural community from African Americans. And there is research that looks at this substantial loss of land in rural communities from African Americans, particularly in the first 3 or 4 decades of the 20th century, when there was a lot of racial violence. And so it's difficult to many times calculate those losses because we don't have exact information of who owned the land and how much it was worth. But in areas where we do, we're finding substantial losses per family in these rural areas in the South in the early 20th century.
Thank you. That was a story I had not heard yet, so I appreciate you bringing that one in. Next, we will turn to Lynn, a colleague here at Freddie Mac, to share his thoughts on the mortgage market during these times. Lynn keeps a sharp eye on the macroeconomic data, including the housing data, to ensure that we are prepared to respond appropriately. It seems as if the housing and mortgage market have been bright spots during this health crisis. What are you seeing in terms of mortgage activity, and has the pandemic affected our market forecast?
Great. Thanks, Doris. Fantastic panel. Happy to be here with folks. And I think I'm going to touch on some of the things the other panelists may have talked about. This has been an incredible year in terms of just the volatility that financial markets, mortgage markets have faced as the housing market, as you mentioned, has been a relative bright spot, but in an economy that's really suffering. There's still a lot of distress out there. Some good news in the more recent housing market data that we've seen here in the late fall, although I want to temper some of our expectations about what that means by providing some perspective on, I think, how we've been thinking about those developments and what that could mean going forward into next year. We're about half a year into this, the coronavirus pandemic had really hit the United States in March of 2020. And over that time, we've really had to change our thinking and update our views about where the economy was headed in the spring of this year. In March and April, the economy was shocked like nothing we've ever seen in the history. The unemployment rate rocketing higher, millions of Americans losing jobs as the economy shut down to battle the pandemic. During that time, initially, the U.S. housing market, we weren't sure where it was going to bottom. It looked very bleak at that time. Housing transactions contracted, housing construction that's desperately needed over the long term, as Rob pointed out, shut down over the spring. But then as we got into summer, we saw the housing market actually start to bounce back pretty significantly. And so now that we're here in the fall of 2020, we're looking at housing market data, mortgage market data that looks very strong. Part of that is due to the fact that we have to catch up for a lost spring, which I want to talk about. And then another part of that has to do with some longer term tailwinds that might be lifting the housing market and overcoming some of these short term headwinds. So how do we make sense of all of this? This is a real challenge. And I look at a lot of economic and housing market data to try to figure out where we might be headed. It's particularly challenging this year given all of the volatility. As the market sort of rebounded over the summer, one of the main drivers of that was mortgage interest rates that reached record low levels. That boosted both the mortgage refinance market, which I want to talk about more a little bit later, but on the home purchase side, we saw home purchase, which contracted very sharply over the spring, respond very strong. There's also significant pent-up demand in the housing market from lost transactions. And if we actually parse the spring housing market data and look forward to where we are, we see remarkably that the U.S. Home sales transaction and home purchase mortgage applications look to have been caught back up to trend, and which makes it somewhat difficult to interpret this more recent fall data. You look at some of the data that the National Association of Realtors has put out on home sales transactions. You look at the Mortgage Bankers Association weekly mortgage application survey, and all of those are showing tremendous year-over-year growth. But part of that tremendous year-over-year growth that catches a lot of headlines, and folks are looking at that, is because that we've seen a shift in the housing market from the spring activity, when typically housing activity ramps up, got delayed and pushed into the summer and into fall, October, September timeframe. And what that has done is created this distortion where it looks like the housing market is really booming. But we have to go back sort of pre-pandemic and think about what trend line we were on. And something I've done sort of regularly throughout this year is to look at, so what if you were to fit a relatively simple trending model on the housing market pre-pandemic? So if you were to look, for example, at home mortgage demand ahead of the overall pandemic, what kind of a pattern would you have been on? And we saw that, with the seasonal pattern, ups and downs, we were on about a 10% year-over-year growth rate. That was completely disrupted over the spring and into summer. But since then, we've seen activity ratchet way up. We've seen home applications, purchase applications up a lot, and home sales correspondingly tracking higher. But a lot of that is simply catch-up growth. If we actually were to look at the trend line of sort of total transactions for the year, we are actually pretty much right on top of it, which, again, given all the challenges facing the economy, is remarkable itself, but is not necessarily pointing to the strength that some might hope for. And there are significant challenges as we get into next year, because a lot of the market was supported this year by tremendous overall stimulus payments. We have forbearance and foreclosure moratorium which helped the market out. And we had extremely low mortgage interest rates. Low mortgage interest rates are likely to be with us into the foreseeable future. Most projections have the rates to remain very low, but some of those other benefits may wane as we get into next year. So a lot of uncertainty there, but cautiously overall, it looks like the home sales market nationally and in many of the markets that Rob highlighted earlier are back on a growth trend. And so some reason there for optimism, but a lot of unequalness below that I think I want to talk about when we think about what's been happening with mortgage refinancing. But overall, housing market at least, seems to have bounced back and gotten back on a trend of positive growth that we were on ahead of the pandemic.
Well, Lynn, that's interesting. With rates so low and the boom in refinance activity, are rural borrowers able to take advantage of these low rates? Can you speak to who is benefiting and who might not be benefiting from this refinance boom?
Yeah, that's a really important thing, and something that I've been doing a research into, is to understand sort of what's been happening with refinance activity. You look at aggregate refinance volumes in terms of dollars, we are going to hit not a record high. Actually, the market was even higher in dollars in 2003, but close to that. And so a tremendous amount of Americans have taken advantage of these low interest rates by refinancing. But there is a wide discrepancy when you look at actually who is taking advantage of those low interest rates. So one thing that we've done is we look at the portfolio of conventional loans. Now, many rural borrowers have, FHA, VA, or government insurance loans, RHS loans, but there still are a lot of conventional borrowers in the rural markets. And so we analyze those borrowers and look at sort of outstanding pool of mortgages, sort of all the mortgages outstanding in the conventional market in 2020, headed into this period. And we look at those borrowers and we look at sort of what their current balance is, what their interest rate is on the current mortgage, and look at the remaining term. And based on that, and then looking at what market interest rates are, you can compare and sort of see where the refinance incentive was. And with interest rates hitting a record low multiple times this year, many homeowners were pushed into sort of a situation where it looked like it was very advantageous for them to refinance. They could save quite substantially if they were to take advantage and lock in those new record low interest rates. About $10,000 in net present value on average for these borrowers in 2020. And then we look at sort of who actually took advantage of that. And with the mortgage market booming, refinance activity really heating up, we see a lot of refinance activity, but a real disparity in rural markets across the income spectrum. Now, higher income borrowers tend to have higher balances, so their incentive to refinance tends to be greater. But if we neutralize that and just look at borrowers who the interest rate declines in 2020 pushed them into the money for refinance, where it looked very advantageous this year for them to refinance, we see a very stark difference. The gap between highest income and low income borrowers nationally overall, in terms of their refinance take-up rates, about double for all borrowers, but in rural areas it's about three times. So many of the higher income borrowers in rural areas are taking advantage of these low interest rates. They tend to be working in industries where they haven't seen as much disruption. They tend to be able to do remote work, take advantage of those low interest rates, lock them in, whereas many of the lower income borrowers have not had those same advantages. And over the long term, that creates significant disparity in terms of wealth creation and income, because they continue to pay a higher interest rate on their outstanding mortgage. That's lost savings to the tune of $10,000 on average. For the lower income borrowers, it's about $5,000, but that's net of refinance costs, and those are pretty substantial savings that are foregone. And so as we look in the marketplace, we're thinking about sort of a market that's sort of seeing a lot of refinance volume, but there's still a whole lot more potential out there. And to the extent that those borrowers in those rural areas are able to take advantage of that, that's going to create significant potential savings for them, and also create some stimulus on the consumption side, because they can take those savings, they may use them to help pay down other debts, or they can use them to help finance other spending. There's also cash out activity. Borrowers have a lot of equity, may want to seek to actually take advantage of low rates and extract some equity through a cash out refinance and use those funds to help with home improvement projects, which that sector is booming, as Rob had mentioned. So overall, while the market is very hot, there's still a lot of opportunity out there. and it's falling differently into different income segments. And if that persists over long term, that's going to have big implications for wealth into the future.
Thank you, Lynn. I want to thank Lynn, Trevon, and Rob for this great discussion, for all of the additional information from the historical perspective, as well as the current economic situation that we're in. I also want to point out that we have some opportunities for you later in this symposium to follow up on some of the topics that were raised today. Right after this session, the next session is actually our COVID-19, the impact on housing in rural America. So if you found some of the COVID-19 discussion here interesting, I hope you'll join us for that conversation as well. Tomorrow, we also have the Housing Supply Solutions Showcase. And I think that'll be a nice follow-up to the conversation that we had today from the 5 Ls and the housing supply side. And furthermore, in the afternoon, late in the afternoon, we're going to have some virtual networking in lounges where you can have more detailed conversation with myself, and I know others from Freddie Mac will be there to chat with you further about some of the topics and conversation that you're hearing today. Again, thank you, Lynn, Trevon, and Rob. That was a fantastic discussion. I want to thank everyone here for joining us today for the first panel discussion of our Rural Research Symposium. Before you head into your break, just take a quick moment to complete the survey immediately following the session, and have a great afternoon, everyone.